Welcome to our monthly property update. 12 months ago, the worm had just turned on property prices, which had recently hit a floor, down 9.1% from peak. Then, and even now, some within the market are forecasting falls of up to 30% from peak. Not only has this not happened, but prices across 2023 recovered their lost ground and continued to appreciate. This calendar year, residential house prices are expected to appreciate by about 5%. What's driving that? It's the structural issues which are so embedded within the residential property market that will take a long time to tilt. Population growth. While this will mean revert over a fairly short period given government intervention, last financial year saw our population grow by around 650,000. That's about the entire population of Tasmania. More Australians than ever before needing a place to live. Residential vacancies are at near record lows, which is driving rental inflation. It is very tough for renters trying to find affordable housing, indeed any housing. Add to that the deep-rooted structural undersupply of new houses being built. These microtrends aren't going to change overnight and will keep a floor under the Australian residential property market. What has driven the performance of the Australian property market over the last circa 18 months has been simple economics. The tension between demand versus supply. Let's unpick the supply of Australian property on the market. The headline: residential listing volumes are well below their long-run average. One of the key contributors to this is the structural undersupply of new houses being built, with building approvals nationally near decadal lows. If we look over our history of dwelling approvals, and at the start of last decade, rolling approvals and completion numbers jumped. And yes, these numbers can be volatile. Following the end of the last cyclical peak, completions then fell hard. The supply constraints on materials were particularly pronounced with the onset of COVID lockdowns and have never really recovered. The number has tracked low at a moment when it needs to track higher. The end goal of all this activity is completions. We're just not getting the properties built. With this in mind, the federal government announced a $6.2 billion in specific housing initiatives in its recent May budget. Some of the key spending initiatives address supply, providing states and territories with additional funding for connecting essential services such as water, power, sewerage, and roads, thereby hoping to stimulate top-down supply of stock. Providing 20,000 new fee-free TAFE places in courses relevant to the construction sector. These are in addition to the Housing Australian Future Fund, which was announced last September with the goal of building 30,000 new and affordable social homes in the fund's first 5 years. There is no silver bullet to fix the housing shortfalls, particularly with the forecasted supply shortfall of 100,000 dwellings to the end of 2028. That's years more of the same. And it waits to be seen if these plans will even move the needle at all. All of this means one thing. Australia is looking into structurally higher property prices now and into the future. There will be some cyclicality, but without the cyclical busts we have seen at different points in time. For investors, Australian property is likely to remain an attractive asset class, whether through a direct holding such as an investment property or through a portfolio of property-backed security, such as our almost 20 billion Australian real estate private credit investment strategies. We look forward to bringing you further updates on the Australian property market. Until then, thank you for watching.